So welcome again to Dollars and Making Sense, a weekly radio show, video cast and podcast featuring Henry Jennings from Markets Today, and I'm Ray Treverson from OTG Capital. Again, thanks very kindly. It's still a small audience, but we're starting to build. We really appreciate some of the comments that are now starting to come through and some of the questions that we'll address not necessarily today, but certainly in the next few weeks. And also, comments and a new format that we've just kicked off with the podcast as well. So again, for those of you that aren't aware, we use the video cast today as a foundation for a radio show that we do for Radio Northern Beaches. And I also turn this into a podcast as well. So hopefully we get lots of bang for the buck. And depending on the medium that you like, whether it be YouTube, whether it be a radio show here locally if you're in Sydney's Northern Beaches, or a podcast, which you can download and listen to at your own leisure, and also pass that information out. So we separate the interviews from the radio show from what Henry and I talk about. And again, depending on the flavour of what you want, I also provide annotated notes there so that if there's a particular area that you want to skip to, please do. Also, please note there's a subscribe button at the YouTube area. Hit the subscribe button, please. We'd love to hear from you as well with comments, and I'll do my best to get back to you all. So this week I'm focusing Henry, and again, those of you that may or may not be aware, Henry writes for Markets Today, but you also have a daily blog, don't you?
I do. It's called beaksdownunder.com.au, playing on the trading places idea and themes from the 1980s.
Wonderful. And so what I've done here as part of my notes that I refer to, my cheat sheets, I'm actually going to draw from Henry's market wrap from Friday. And again, Henry, you write about Macquarie and also, I guess, fairly ordinary returns from the banks. Can you lead the discussion today about that?
Well, at the moment, currently, it's all about the banks. And we had ANZ reported last week, and as we were suspecting, they weren't particularly flash numbers, let's face it. We've had the Royal Commission, lots of remediation, lots of increased costs for them. We've had a slowing housing market, etc. So ANZ actually cut their franking level. They didn't cut their dividend, they cut their franking level from 100% to 70%, which was pretty significant. And that happened on Halloween, so it's a bit of a shock horror story from them. And again, it was a cautious outlook statement, to say the least. We then backed that up on Friday with Macquarie Group's annual results, or half-yearly results actually for them. And again, Macquarie do a really good job of under-promising and over-delivering. This time they kind of under-promised and almost not under-delivered, but it was pretty much in line with what they'd previously said. So the market initially took that quite negatively, but has subsequently it has bounced back, and certainly hasn't seen the carnage that we've seen in the other four banks in that sector, because we've today, of course, which is Monday anyway, Westpac have come out with their results and have equally, I guess, shocked the market, and they're raising $2.5 billion from institutionals and a share placement to them, and a share purchase plan to retail investors for a huge, quite a big sum of money, $2.5 billion, to shore up their balance sheet, which at the moment is under a little bit of pressure from regulators, and also, not just here, but also in New Zealand as well.
So what are they primarily going to do with that money?
Nothing. Absolutely nothing. Sit it on the balance sheet, basically. They will just take the money and it just will sit there. So accompanying a fall in profits, in cash earnings, which was below what we thought, slightly below, they also cut their dividend. They kept franking unchanged, but they cut their dividend to 80 cents from 94 cents. So again, that's a big cut, and certainly something that I think a lot of retail investors weren't ready for.
So these are the mums and dads, the retirees that are counting on income,
yep,
but also a tax check from the government as well.
Where's my franking credits? Yes.
Okay, so when you talk about ANZ cutting their franking from 100% to 70%, what's the real impact? What's the dollar and cents impact to an investor that is requiring, or that really needs these income coming in to live on?
Well, I guess though those promises that the government and Jeff Wilson were making around about election time. It all depends on what the company's paying.
This is Wilson from Wilson Asset Management and the franking credit
and his crusade,
inquiry, etc.
So it's going to mean a relatively quite a deep cut, I guess, from 100% to 70% in terms of the amount of money you get back from the government as part of that franking credit.
So we didn't need Bill Shorten to necessarily win. It's going to it's happening anyway, isn't it?
It is happening anyway, whether it's by a cut to franking credits. And ANZ did talk about the change to their business mix. Now, 32% of their business profits come from overseas, which means that they don't pay Australian tax on that part of their profits. So as a result, they don't have those franking credits to pass on. But I think it was the stock price was murdered on the back of this, and has continued to be murdered. So it clearly was a shock. Some people were expecting a cut to the dividend, which I guess you can kind of live with. But what we're seeing is in a lower interest rate environment, we're all sharing the pain. Bank shareholders, even the CEO of Westpac lost out on his bonus. I'd say justified.
So instead of having to live on 12 million, he's got to have to live on 8.
No, I think far from. I think his base is 1.6, and he was going to get another 2 and a bit in bonuses, and that's all gone. So he's going to have a tough year this year. There's going to be a bit of shopping at Aldi for.
I don't think there are going to be too many bleeding hearts for him out there. But
no.
So investors are not only looking at cutting dividends, but also a reduction in capital because their shares are now worth less as well.
Yeah, I mean, this is the thing, I guess. Some income investors don't really care what price the shares are. I mean, at the end of the day, it doesn't really matter.
I find that amazing, but please continue.
That's what some people say. I mean, at the end of the day, it doesn't matter whether ANZ are $20 or $10. They might have bought them at $10 years ago, and their yield depends on what they paid for that stock. So,
fair enough.
It really doesn't matter to some people what the share price does. They've got no intention of selling them. All they're interested in is the income that they're receiving.
And the franking credit.
And that franking credit. So as long as the dividends come through, they don't care. But you've got to say that in a low interest rate environment, which we're living in, RBA 0.75, everybody is having to get used to a low interest rate environment. And that includes the banks, which don't do as well. The net interest margin for Westpac came down substantially. And as a result, investors have to get used to the fact that they're no longer going to get 6% fully franked yields in the banks, unless, of course, the bank shares drop a lot. But if you're an investor in the banks and you've had them for 10 years, do you care what the share price does?
Not if you're holding that long, no.
Do you care what, at the end of the day, do you really care?
Well, you can't live on it. You can only live on what they send you to your bank account, because that transcends into money.
Yeah, I mean, clearly, if you're looking to sell some of those shares periodically, then the share price has an effect. But if you're long from Westpac, I remember in the 90s, Westpac had a rights issue at $2.50. They nearly went bankrupt. They had a rights issue at $2.50, and ironically, AMP bailed them out, as did Kerry Packer at $2.50. $2.50. They last raised money 4 years ago at $25.50. They raised $3.5 billion 4 years ago, and the share price is pretty much gone nowhere in 4 years. So we've had ups, we've had downs, but at the end of the day, the share price has gone nowhere. But you have picked up a 5.5%, 6.5% fully franked dividend, which is what you care about if you're a retiree that just cares about income.
Yeah, no, fair enough. Okay, so rolling on, you've given an interesting list of stocks, and so Henry's take, your take from last week. What's your overall take then? You've got no rush as banks struggle and the like. So what do you think investors should be looking for this week?
Well, we've got the RBA tomorrow.
That's right, Melbourne Cup Day.
We've got Melbourne Cup tomorrow.
The traditional interest rate announcement.
There won't be any interest rate cut tomorrow. And I think that the RBA has now pretty much told everybody that's listening and reading between the lines that that's it. We're done.
Yeah,
we can do no more. And I think the Fed has done the same. The Fed cut their rates last week. This is the US Federal Reserve. Jerome Powell cut rates last week by 25 basis points, and I think they're done. I think we saw on Friday we had some pretty buoyant employment numbers out of the US, which actually flew in the face of what we were seeing on the ground in terms of there was a General Motors strike that's been going on for a while, which was going to affect the figures. So we've seen good numbers coming out of the US. We've seen slightly better numbers coming out here. especially with the housing market picking up, and
that's my next.
Every Saturday, of course, it's bonanza time for those people that are selling.
That's my next highlighted one here. CoreLogic, Melbourne increasing recording a 2.3% increase, and Sydney 1.7%. And again, the clearance rate is through the roof.
Yeah.
And again, those that are selling are walking away with very, very big smiles on their dials.
Well, they are, but you've got to remember this is all relative, because if you're not downsizing, or you're not moving out of the area, or moving out of Sydney and moving to somewhere else, then you've got to buy something.
The old quandary, nothing's changed.
Okay, so you get $100,000 more for your house. But then when you go and buy another house, you're paying $100,000 more for that house.
Well, you've got to stamp it as well. So there's your $100,000.
There's $100,000 in costs.
Yeah. Okay, well, let's wrap up on that one. And again, for those of you that do see Henry's blog, at the end of last Friday's, there's a number of very funny jokes, I must say, Henry. What do you call a South African holding a bottle of champagne after the Rugby World Cup final? The answer here says waiter, but I think they're a little more joyous than what you would hope.
They are a little more joyous than what I would hope. So it was an Englishman holding the champagne.
Oh, well, not to worry. Okay, so the next clipping that I'm going to start referring to for our discussion comes back to, I guess, a validation about what we've been talking about, listeners and viewers, in the past few weeks, about when you are evaluating a stock. Henry and I have been talking at length about, IPOs like WeWork, where you had a lot of froth and bubble coming out and talking about a potential IPO, and really talking it up about, this is going to be fabulous. And when you sort of looked under the covers, you sort of scratched your head, and I certainly did, when, basically a real estate company turned up and said, we've got shared offices, and it's like, wow, that's nothing innovative. And Henry, your comment was, I think they give free beer, wasn't it?
Yeah, that's always a winner.
That's always a winner, I guess. But for those poor old investors, and namely SoftBank in this instance, that backed that IPO, they've been taking a hiding. What's the output now then on the WeWork IPO, Henry?
Well, it's been shelved. Effectively, it's off the horizon, and it's gone from a $40 billion company in theory to a company that's having to be rescued by its major shareholders. So the founders walked away with about 1.7 billion.
Yeah, it's amazing, isn't it?
He's done an extraordinary job. For himself,
self-enrichment.
Yeah, well, that's what America is all about. So it's that one's shelved. The big news, I guess, in the last few days is that Saudi Arabia is going to float the world's biggest company, and this is a stock. This is a company called Aramco, which is pretty much the Saudi government's oil company, which is in control of the Saudi oil fields. So it's a massive. The valuation is going to be interesting to see what they do with it. They're only going to float only around 100 billion. Should do the Austin Powers thing. 100 billion in terms of a capital raise, and they're only looking at floating a very small part of it, around 2%. It's going to list on the Riyadh Stock Exchange mid-December. And 100 billion, that's a huge amount of money to suck out of the financial system and put it into Aramco. And the idea is the Crown Prince is basically trying to upgrade Saudi by selling part of the Aramco business.
But I mean, many investors will be sort of scrambling around to find out, how the heck do I even invest in a Riyadh stock market?
Yeah, well, I think the spiel goes that most of the money is going to be coming from the region. I suspect they're going to rely on a lot of others, but they are going to be listing this on other stock exchanges in time. So it's going to have around, some people say it's around 1.5 trillion valuation. Others say around 2.5 trillion.
That will be astounding amount of money.
Twice the size of Apple and Microsoft.
It's an astounding amount of money. It really is. And I guess part of that validation of what we're doing week by week, listeners and viewers, is that we're trying to, I guess, do the education piece, but also provide some gems that you hopefully take away and will decide whether you invest or don't. But we looked at aspects of WeWork and the froth and bubble, but we've also been talking about WiseTech, and in the same validation piece that I've been reading in the last week. we're talking right now, and again, this was a really interesting stat. There are now more stocks on the ASX with less than 50 million of revenue, but market caps of over half a billion. So in other words, a PE of greater than 10, there has been at any point in the last 10 years. So if you translate that back into common speak, there's a lot of bullshit out there right now, isn't there?
Yeah, and Ray, that 50 million is not profit or earnings. That's revenue.
That's revenue.
So it's not a PE.
So it's turnover.
10. So it's not a PE of 10, because that's price to earnings,
yes.
not price to revenue.
Not price to revenue, exactly. Thank you for that clarity.
So there is an awful lot of froth and bubble out there. Some of it justified, I guess. Some of these stocks that have got high valuations, they may deserve those high valuations because they do offer extraordinary growth. They may have got into the sector. And if you looked at something like Afterpay a few years ago, the growth profile still of Afterpay is pretty impressive. It's just that they've chosen, I guess, to reinvest that money back into the business, back into the US business especially. If they just stayed here, they would arguably probably been doing somewhat better in some ways, at least on the revenue into actual profits front, rather than reinvesting that money back into the business. But, as with all these businesses, like Amazon have over the years, they have not made any money because they've been pumping it back into the business to create this behemoth.
Yeah, it's enormous.
Now, whether Afterpay is in a similar vein, or whether WiseTech, we've talked about that last week in terms of that bear raid by that fund, and people, it's gone a bit quiet on that now, so people have been a little bit more optimistic about WiseTech. And of course, we've had the US market going to all-time highs, so people are going, well, I need to make some money. Christmas is coming.
But you see, again, I come back to what we've talked about in the last few weeks. This rush of money into equity still comes back to the fact that there's a ton load of capital lying around and no home for it to go to. So it's gravitating to equities, but that doesn't necessarily mean that it's right.
No, that doesn't necessarily mean that it's right, but it does mean that there is little alternative, or there is no alternative, Tina, or there are few alternatives, Taffa. It is, or Tiller. There is little alternative. It is hard at the moment.
We'll put all these TLAs up on our website sooner or later. Our 3-letter acronyms.
It is hard for investors at the moment because money in the bank does nothing.
It's doing nothing.
You're just
Although
Westpac
charged. Doesn't mind that. They don't mind their customer deposits being up there.
No, well, that does help them a little bit, but certainly, putting your money in the bank, it's better to put it under the mattress, to be honest. At least you're not going to get charged for that money.
Good point. I mean,
which is why some people are buying gold.
And again, it's a what's the a pursuit stock, or what's the term I'm looking for when people are rushing away? The escape stock.
Right.
They're escaping from the reality, so that they escape to gold as a potential.
Funnily enough, gold has held up remarkably well, considering it was kind of this price when there's lots of turmoil and trade talk about it all falling over and tweets every night abusing the Chinese and vice versa. Gold has held up remarkably well, so there is a demand for it, for physical gold, and we know that China has been buying an awful lot of physical gold.
Yeah, it's interesting. Again, always interesting times. And I guess the final comment that I draw from this particular reading that I did during the week was that, whilst we're looking at these well-publicised and frothy type of IPOs and the like, what's likely to perform better over the next decade? Will it be speculative and popular? We think not. And again,
I don't know.
But again, I think that, if we're talking about educating investors, if you are looking at froth and bubble, I always say to people, look, if you're happy to invest in that, do so, but with the open eyes and knowledge that you are taking a risk. But then, also look very very closely at not putting it all on, putting the whole bet on the nose, for example, using horse racing parlance for tomorrow, but you don't put it all on the one bet. And so if you're going to be speculative, maybe 1 to 3% of your portfolio, for example, but nothing more on one of those. So, the WAAAX stocks are there, and we've talked about them last week, and, they're a little off flavour right now. But I see some glimmer there because some of those are good companies with good solid offerings. yes, they're building, but in 5 to 7 years' time, they're going to be dominant, they're going to be making great revenue, and so they should be a good investment today.
Yeah. I mean, let's face it, if you look at the conservative investment, which is putting your money in Australian banks, they're going nowhere in 4 years.
Well, we've gone over that one well and truly.
So if you put your money in WiseTech, Appen, Altium, Afterpay, all those, you'd have been a happy bunny.
Absolutely.
And they're the speculative stocks. So, in 10 years, who knows what the theme is going to be, because it was only 11 years ago the iPhone came out.
And it was only 11 years ago that the GFC actually hit.
Yeah.
It was about that time. And again, this is the other thing that I like to let many investors know when they're starting to review particular investments. That 10-year yield of an investment now does not include 2008, 2009.
No.
The year when the market got decimated. So all of a sudden, when you start looking at management funds and investment funds and the like, or whatever name they want to use, they will look at 10-year yields and say, look how good it's done. Again, I simply say to people, ask them to go back 1 or 2 more years during the GFC, and I think that's still a telling factor. How did they necessarily do when, the hell was going in a hand water and, we were in trouble? So, a fund manager, anybody can make money on the markets today because we're keeping going through record highs. My test of a good fund manager is, how do you do when the times aren't quite so good?
I don't think anybody did very well in the GFC, so you're all in the same boat.
Potentially. Some did less worse than others.
Yeah, some did less worse than others, but all the pretty girls get killed in the bus crash as well.
Oh, that's an analogy. Good time at this point.
Hi, this is the disclaimer text. We're talking today about stocks, and thanks for listening to Dollars and Making Sense. This is a weekly program about finance, money, and investing. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your own personal circumstances. And if in doubt, please contact an authorised financial planner or your advisor.
Thanks for that, Henry. And again, we keep on reiterating that disclaimer to make sure that you totally understand. We give recommendations, but we don't give advice. And we don't know what your personal circumstances are. So, investing in one stock might be perfectly fine for somebody, but total disaster for other people. So always take that in mind. And I guess rounding out our discussion around stocks and the like, do you have a particular stock that you think people should be running from or running to as a result of, since the last time we talked this time last week?
I guess one that's starting to interest me, and we've seen it perk up a little bit, is a nice fat big cap oil and gas producer that actually has a relatively good yield, and that's Woodside Petroleum, which has actually been left behind this year. You look at the rise in Santos, which has been meteoric to say the least. It has done an absolutely fantastic job this year, Santos. Big turnaround story, big leverage to the oil price, but the oil price hasn't really gone anywhere. But Santos, I think, is up around 50% this year.
Wow.
Whereas Woodside, I think, around 4%. So this kind of plays into the whole Saudi Aramco thing. You would imagine that they are not going to crater the oil price or not going to make the oil price look weak when they're trying to flog $100 billion
of equity.
worth of equity in the world's biggest company to unsuspecting shareholders in the region. You cannot believe that they won't try and massage and talk the oil price up. Because
so this is a good side play then to Aramco, is what you're saying?
Yeah, I mean, this has always been my theory, is that you're not going to crater the commodity that makes you all the money and talk it down or oversupply or whatever during this process. So Woodside has underperformed. It does pay a relatively good yield. It's not as sexy as Santos, that's for sure. Peter Coleman at Woodside is not as sexy as Kevin Gallagher. Peter Coleman is an operations guy. Kevin Gallagher is very much ambition. He's got a lot more ambition, I think, for Santos, and we've seen that. They've done a number of really spectacularly good deals, which have changed the nature of the company, whereas Woodside have tended to be on the back foot on that. But I think
so, more of a plotter along.
It's a plotter. It's a producer. They're consistently good. But, Santos up 49%, Woodside up 4%. You can see that Santos has rolled the dice and has achieved...
but will that drag Woodside along, do you think, the success of Santos?
It hasn't so far, but I think, as we hit towards the end of the year and we do get this Aramco kind of rev up going, it's going to be starting to be trickling into our market to some extent. And you look at Woodside and you think, you know what, maybe they've been left behind a little bit. So I just think
there's a potential value purchase there.
I think there's the potential, 10-15% before the end of the year in Woodside.
Okay. Henry's call,
which wouldn't be out of place.
And what's the ticker for Woodside?
WPL is the ticker.
WPL.AX. So we'll keep an eye on that one over the next few weeks to see if that comes true. And again, listeners and viewers, what we're doing as well is week by week, as Henry is giving these interesting recommendations and tips, I'll be tracking those as part of my blogging as well. And again, from that perspective of, you go back in time and sort of look at, at that particular time when Henry, for example, you've given a recommendation around premium. We've also looked at a couple of others, and we're just going to track those as we do these week by week blogs and YouTube videos and just see how we go. And again, I don't expect you to pick winners each and every time. Obviously, we'd be thrilled if you do.
Well, if I do, I won't be here doing this podcast.
Nice to know. Well, I'll ring you from Monte Carlo then, or wherever you might be.
You can ring me from Cortina.
Cortina, okay. Bit of skiing then as well. What the heck? Okay, so now I'm going to move on to an article that really caught my eye. It's actually this morning that it came out. It's from your company's namesake, Marcus Padley.
Yeah.
And this is near and dear to my heart, I guess, because I speak to a lot of retirees and superannuants or just about to be retirees. And one of the things that Marcus Padley has written about today, and he's titled it, the article is, it's talking about Penniless at 100. So, Henry, I don't know if you have had a chance to look through this in detail, but one of the big misconceptions that people have around superannuation is that super is there for retirees to actually pass on money to somebody else. In other words, the kids to have a legacy or an inheritance. But the very design of the way that super was made to work was that by the time you're in your early 90s, there's nothing left. So you're actually supposed to draw down capital. But again, Marcus makes this interesting point that the yields have been so good in the last 10 years, people have been able to live off the income and their capital is still intact. What do you think the impact of that's going to be as we look forward, say, to maybe the next 10 years that we're now in this very low yield environment?
Well, certainly the question has been over the last few years, or the answer has been, is that people could live off that yield, live off that income without raising their risk profile. And at the end of the day, you can still live off, the bank dividends, although they're down, they're still not, you're still going to be able to live off those. You might have to adjust a little bit, but they're still sort of 5.5%, which, given where official interest rates are in a low interest rate environment and that no alternative, you're still going to be able to live off those bank dividends. The problem has become is that you've had to move up the risk curve and take on more risk for the same amount of income, the same amount of dollars. Now, whether that risk has been to embrace hybrids, which have been very, very popular, and they are a kind of a floating rate
so just explain to those that may not know, what's a hybrid in that regard?
A hybrid, well, we used to call them convertibles, but they've now become called hybrids, and they're basically a bond, usually issued by banks or very good issuing houses, that offer you an interest rate, a set interest rate above what they call BBSW, which is the bank bill swap rate.
That's right.
So say the bank bill swap rate is 1%, they'll say, well, we'll offer 4% above it, so you'll get 5%. There is no franking involved in this, but it's not an equity product, so that the price of that debt, that hybrid, does not have the same volatility that you would expect.
You know what you're getting, though.
You know what you're getting.
It's consistent.
You know what you're getting. And they have proved to be massively popular, and the banks have issued tons of these things, as have lots of companies, because it's cheap financing for them. Now, the risk, if there is some risk in these, is that they're all different. Each hybrid has a different kind of event horizon in terms of what happens to it under certain circumstances, because they are debt. They are if the bank was to go bust, they would go to zero, and then you'd be in the queue to get your money back. Obviously, the share price would go to zero as well, so they rank higher up the list than an ordinary shareholder, but they're not as big up the list as other forms of credit.
But but if we give some context to that risk, so let's talk about Westpac going bust.
Yeah.
Okay, when we think about the last 10, 15 years of financial history on the planet, we've really only seen sort of one country where we've had this kind of massive financial malaise, and that would be, in my mind, I'm thinking Cyprus, for example, where the government came in, snatched savings and said, that's all ours now.
Right.
But is that the kind of calamitous kind of environment that you're talking about, sovereign risk, that would risk that kind of hybrid investment, or are we talking something less calamitous that would necessarily put those kind of incomes and returns on the chopping block?
Cyprus wouldn't have sprung to my mind. There's certainly less calamitous events that have happened at Westpac. For those with long memories or a few notches in the under your belt, you will remember that Westpac came very close to bankruptcy in the early 90s. They did a capital raising at $2.50, which was
earlier in the program,
which was supported by the AMP and Kerry Packer, because they were close to the edge. Now, I'm not suggesting that's going to happen.
But that was poor management, or
it was poor management, circumstances. It was the recession we had to have. We haven't had a recession since the early 90s in Australia. That was the recession we have to have. And like investors, investors have to move up the risk curve to get their returns. So do the banks. The banks have to move up the risk curve. And then we've seen that with housing lending over the last decade. They've had to lend more money to riskier people effectively, and luckily the house prices have pretty much gone up and taken care of all that risk. But if we did see a recession in this country, we did see a jobless rate start to creep up and jobs, it gets into an unvirtuous cycle of a spiral downwards, and that when the banks have so much of their earnings based on the housing market, that can be problematic. So with these hybrids, they all have kind of different risks. Each hybrid product is different, so you really have to read the PDS. Some are very kind of vanilla. Some convert into stock. Some convert into just cash. It just depends on them. But they have been really, really popular because they are a good way to increase your yield while seemingly not embracing risk and moving up that risk curve.
So Marcus goes on to then talk about these particular investors that are having to crawl up the yield curve, but the problem is they're not experienced. A lot of the mums and dads aren't necessarily good investors. They're and again he describes what I see very typically. A lot of retirees with the banks, they've got Telstra, they've got BHP, they're getting franking credits, and they really haven't had a shock to the system since the GFC.
No.
And as you've said, we haven't had a recession for close to 30 years now. And so the real bottom line, and again, I'm quoting from this article, they cannot afford to have the equity market fall if they're only drawing $45,000 to $50,000 a year in tax-free income. And so that together with inflation being the issue. And again, Marcus goes on to talk about, we know the RBA says it's less than 2%, but again, and I totally agree with this sentiment, the ABS obviously don't eat anything, insure anything, have utility bills, drink coffee, or drive anywhere because they're oblivious that real prices are still going up.
Yeah. The thing about the CPI, the thing about the official CPI is that it has been designed over the years to go down. They've taken away all the stuff that really matters from the CPI. And I had this argument with Shane Oliver once, is that when inflation was a problem, they tried to make it less of a problem by moving the goalposts so that the CPI...
So they just measure different things to get a different result.
They measure different things to get a CPI which is low. The real world, we know, is not CPI. The real world, you go through the beep machine on the Eastern Distributor when it goes beep, $7.76 now.
I know, it's astounding. We talked about this last week.
And I drove 300...
It's great if you're an investor.
I drove 300 metres on the thing, and it's $7.76. So we all know that CPI is not what they say, and because they've taken all the stuff out of it that they thought would really be a problem, it's now really hard to stick that stuff back in and reflect the CPI. And because they've got this 2 to 3% CPI range, they've really shot themselves in the foot.
They have.
And it makes it very difficult to get to 2 to 3% ever. And very few countries have been able to do that because we've taken all the expensive stuff out.
So again, he goes on. Interest rates are going to zero, although we just talked already today.
Yeah,
we believe that's not going to go any further. Risk-free investments are going to yield next to nothing. They already do, and I think we all agree quite wisely that that is the case. Banks are going to cut their dividends and franking. The ANZ just did. Okay, the stock market return is not reliable, and we know that that's not the case. And again, it assumes if you want to stay in your big house. So, there's a whole range of factors that Marcus is talking about, that retirees are being pushed into the equity market now, looking for a yield that's going to have to put their capital at risk. And that's what we've talked about, moving up that risk curve.
I mean, we have created a monster. I mean, compulsory superannuation levy, and all the money that goes into superannuation in this country.
Close enough to $3 trillion.
We have created a monster. We've created a massive industry around it. There's a lot of players, there's a lot of snouts in the trough. And as a result, you've got to earn your fees, you've got to make your money, because you want your cars and you want your waterfront homes if you're running one of these big financial services companies. So you've got to keep pushing this mantra, equities, equity. But where else are you going to? This is the problem. Where else are you going to buy diamonds? I've seen a lot of adverts for diamonds at the moment.
Funny you say that. Well, I've actually got an interview. I've got an interview in the can with one of the vendors at the AAA conference earlier this year that do pink diamonds.
Yep.
And again, I was fascinated when she was telling me what the returns were. I was sort of going, "Wow, that's pretty darn good." So I guess we're just about out of time today. I will put the link up on the YouTube video and also our blog on this particular article from Marcus, Penniless at 100.
Penniless at 100. I'd be happy if I lived to 100.
I guess we all will be, but again, it's a quality of life that we're hoping that we're going to take with us along for the ride. So again, Marcus is an interesting guy to listen to. And his final comment is, get rid of that spare room or your kids are never going to leave.
No.
And again, you and I both have children in that sphere of 20-somethings.
I've got kids that have left.
Mine are still here. One of them's behind the camera, in fact, but that's okay.
My kids have a burning desire to get away from us.
So do mine.
They go and live in Croatia and Berlin and London and things.
But they ain't here in Sydney buying real estate, are they?
Why would you?
Bingo.
You'd have rocks in your head.
Bingo. Okay, so with that in mind, keep an eye out for our next week's podcast, video cast, and YouTube and radio show. We'll be posting all the companies that we've mentioned today on the annotations and the like. And just closing out, we talked about a company to run to. Is there any company that really sticks in your mind that people should be running from?
Running from, I think, as a sector at the moment, people are running from the bank sector. And I think we've had a wake-up call. ANZ, Westpac, we've got NABs to come. CBA is not in this cycle, but certainly, the banks are now low growth, yield investments. The fact that they have gone nowhere in 4 years is telling you something. Raised money at 25, 50, 4 years ago, they're doing it again now. It's telling you something.
The indicators are all there. Okay, Henry, as always, thank you so kindly for your insights and your expertise. It's very much appreciated. Listeners, viewers, again, all the links. Hit the subscribe buttons. Check out our socials. And we really enjoy the feedbacks. Again, the audience is building and we really appreciate your participation. That's all for us. Thanks until next time.